Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to lowest rates at the lowest costs in Arizona. And if you don't believe me, call me. Here is this week's mortgage market at a glance. Rising rate headlines are nothing new, but there was a bit of a double whammy this week, or triple depending on your point of view. It's March 2021, and you'd have to go back to March 2020 to see higher mortgage rates. It will take mainstream media a while to catch up with the new reality because the most widely cited mortgage rate survey tends to lag behind sharp moves like this. And that brings us to whammy number 2. This move has been surprisingly abrupt. Not only have rates risen about as fast as they ever do in the past 2 months, there have also been several false starts where it looked like rates were catching a break only to jump much higher in a single day. Friday was one of those exceptions. The first 4 days of the week were among the more hopeful and resilient we've seen in 2021. 10-year Treasury yields at benchmark for momentum and longer-term rates like mortgages were holding safely below their recent 1.26% ceiling, even trading below 1.5% briefly on Thursday. Things changed abruptly on Friday. A stark absence of any overt short-term motivation makes this whammy all more frustrating. In other words, there weren't any big new developments that caused the jump. It was just the way traders traded. This chart may not look like much, but it's just a small section of a bigger trend, and that bigger trend represents a noticeable acceleration from the previous trend of rising rates. Incidentally, this week's installment takes 10-year yields back above their pre-COVID floor for the first time. Speaking of COVID, that's ultimately why traders are trading this way. The acceleration in 2021 is all about increased vaccine distribution, sharp declines in case counts, and the passage of more COVID relief stimulus, which hurts rates in 2 ways. Number 1, by increasing economic activity, inflation, and 2, by adding Treasury supply. Here's another look at the same chart, this time with emphasis on the COVID effect and the subsequent bounce back. If it doesn't feel like mortgage rates got quite as much warning as suggested by Treasury charts, that's because they didn't. To be fair, I did warn against complacency when rates were still at their all-time lows. But it's one thing for me to point out the risk, and quite another to see rates jump 0.5% in February alone. So why didn't the rates get the memos from the Treasuries? In a nutshell, the mortgage market couldn't keep pace with the broader bond market. Mortgage rates were able to keep falling and remain lower because they were still getting caught up to move with the bonds. I referenced this in several times as the cushion, and here's another look. The first 2 whammies are bad enough or good enough if you're willing to view higher rates as the logical byproduct of the fight against the COVID. The third, thankfully, only applies to a small section of the mortgage market, but for those with second homes or investment properties, it may still sting a bit. In the final days of the previous administration, Treasury and the FHFA amended terms of Fannie and Freddie's bailout agreement in such a way as to limit the amount of certain types of loans that could be acquired. This week, Fannie Mae finally formalized the announcement and began contracting lenders that had too many second home or investment loans on their books. The result? Several lenders immediately jacked up fees on these loans, some by huge amounts, like 5 basis points or $20K on a $400K loan. Yeah, that stings. For those who didn't respond immediately, they are expected to follow suit in the near future, even if not all of them will be as severe as the early adopters. So what does this mean for you? Simply put, if you have an unlocked investment property or second home loan that's in process, it may have just gotten a little more expensive. That won't be the case for everyone though. Not at first, anyway. So definitely check with your mortgage professional to see what your options are, or feel free to reach out to me. So there you have this week's Mortgage Market at a Glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or need to refinance a home in Arizona, I would like to be your broker of choice. And until next time, take care and stay safe.